Hello everyone, this is Sam Hillside with a new topic for today, which is all about the accounting equation. In that video, I will talk to you about the components of the accounting equation, why it is so important to understand and digest the accounting equation, and on the other hand, what are the limitations of the accounting equation. Stay tuned. The accounting equation is considered to be the foundation of the double entry accounting system. On a company's balance sheet, it shows that the company's total assets are equal to the sum of the company's liabilities and shareholders' equity. Based on this double entry system, the accounting equation ensures that the balance sheet remains balanced, and each entry made on the debit side should have a corresponding entry on the credit side. Let me give you an example to make double entry clearer. If a company buys raw material through cash, that would increase the inventory as you receive items in your store. And on the other hand, your cash will be decreased as you pay for the purchase. Because there are two or more accounts affected by every transaction carried out by a company, that accounting system is referred to as a double entry accounting. The accounting equation formula says that assets equal liabilities and owner's equity. The financial position of any business, large or small, is assessed based on two key parts of the balance sheet: assets and liabilities. Owner's equities or shareholders' equity is the third section of the balance sheet. The accounting equation is a representation of how the three important components are associated with each other. The accounting equation is also called the basic accounting equation or the balance sheet equation. Assets represent the valuable resources controlled by the company. The liabilities represent the company's obligations. Both liabilities and shareholders' equity represent how the assets of any company are financed, sources used in your finance of your assets. If it is financed through debt, it will show as a liability, and if it is financed through issuing equity shares to investors, it will show in shareholders' equity. Simple as that. The accounting equation helps to assess whether the business transactions carried out by the company are being accurately reflected in the books and accounts. Below, I will give you some examples of components listed on the balance sheet, or so-called statement of financial position. The first item is assets, which can be classified as current assets or fixed assets. Current assets include cash and cash equivalent or liquid assets, which may include accounts receivable, which are the amount of money owed to the company by its customers for the sale of its products and services. Fixed assets include items like buildings, machineries, and furniture. The second item is liabilities, and those are what a company typically owes to others or suppliers. Liabilities include your debt and all other payable amounts like rent, taxes, utilities, salaries, loans, and dividends payable. The third item on the balance sheet is shareholders' equity, and it is a company's total assets minus its total liabilities. Shareholders' equity represents the amount of money that would be returned to shareholders if all the assets were liquidated and all of the company's debt was paid off. So it is the net available for the owners after using all assets to settle all liabilities. The fourth item on the balance sheet is retained earnings. Retained earnings are part of the shareholders' equity and are equal to the sum of total earnings that were not paid to shareholders as dividends. As its name suggests, it is retained or reserved. Think of retained earnings as savings, since it represents a cumulative total of profit that have been saved and put aside or retained for future use. Although the balance sheet always balances out and it captures the relationship between the three components of a balance sheet, assets, liabilities, and equity, the accounting equation doesn't provide investors enough information about how well a company is performed. Investors must interpret the numbers and decide for themselves whether the company has too many or too few liabilities and assets, and what is the gearing and financial risks level of the company. That means the balance sheet alone cannot give the investors a full picture about the company's performance or growth. That's why further and deep financial analysis need to be performed on the financial balance sheets. Well, that wraps up our topic for today. I'm Sam Hillside. Thank you so much for watching me. Until next time, see you soon.